So typically, most of the time, you're going to want to have 5 to 6 months of expenses for that property ready to go in the event that you can't find a tenant or you can't rent it out to anybody. It's checking those boxes. And the thing is the math will work in all 50 states, right? So even though a lot of people from California like to invest in Ohio or different states because it's a lot cheaper, but really the math works in all states. And it's kind of checking those boxes off to know if somebody's ready or not to invest.
What's up, everybody? Welcome back to the Dollars and Dumbbells podcast. I'm your host, Justin Green. Today, I'm excited to bring you a conversation with Ryan Bakke. Learn like a CPA is how you may know him from social media. But Ryan's an expert on tax and real estate investor, and so he's here to talk to you about everything real estate. We got some questions from Instagram to throw at him. But first, let's just kind of start it off. Ryan, introduce yourself and where are you from? Where are you calling in from?
Yeah, so I live in south suburbs of Chicago. So I'm not a Bears fan. I'm a Packers fan, though. So I might as well paint my house green and yellow here because it's a rivalry. I have an accounting and finance background. I worked in management consulting for a few years, and then I eventually broke off and started my own firm helping everyday people build generational wealth, primarily through real estate, but I also have a finance degree. So I actually enjoyed finance a lot more than I did accounting in college. Accounting is more of what happened in the past versus finance is trying to predict what's going to happen in the future. And I enjoy finance and projections a lot more than I did accounting. And so fast forward to today, I have a consulting firm, have about 200 clients that I work with on a one-on-one individual level. And from there, doing that for 2 years kind of laid the groundwork for a lot of my educational products, whether it's through podcasts or courses, or I have my Tax Strategy Academy program where I do weekly group coaching for real estate investors. And really it's just centered around building generational wealth through real estate. So I used to teach just the tax code, but now I also teach people how to actually invest their money, how to do pro formas on deals, how to make sure that you're not wasting or losing your money. And I have real estate investments myself. And so I have 3 different businesses, the CPA firm, the education firm, and then I also do real estate investing syndications.
So you're not busy at all?
No, never. I'm not busy, no.
And it's funny you bring up sports in your intro because that's actually how I reached out to you. So I was following your content for a little bit. You posted like you running pickup at like a YMCA or something like that, right? Like it looked like a local gym. And for anyone listening, if they're a hooper, they're gonna relate to this. But there was a dude wearing sweatpants, and I just commented on it. It was like either that dude's busting everyone's ass or he's like terrible. And you're like, nah, he was busting everyone's ass. Because like anyone who watches or plays hoops just knows if anyone's playing in sweatpants, like there's only one or the other. There's no in between. Like they're top notch or they're like, what are you doing here? So that's kind of how we started talking. So I appreciate you coming on after that. Asked if you wanted to come on. So here we are. So I kind of just wanted to like hit it right out of the gate. Like why real estate? Like why did you like, you could have done the stock market, you could have done real estate, you could have, there's other options you could have went into, but at a young age, you clearly started getting into real estate on your own. Like what made you choose that?
Yeah, it's my grandpa told my dad one time that they're never making more land. And there's obviously property that sits upon the land and it just goes up in value over time. Unless your real estate's next to like a dump truck plant or it's next to really poor housing, it's probably going to go up in value over time. But there's 4 main principles of real estate that the stock market doesn't have. Well, the stock market will have appreciation, but in real estate, you get paid 4 different ways, technically 5, and I'll explain them. So the first thing is you're going to get obviously it's going to be the return on cash flow. So revenue minus all your expenses, you're going to be left with cash over. That's going to be your cash flow return. You're also going to get a return in the fact that you're having your tenant or your guests pay down the equity on your property. So they're going to help you pay down the loan, and that has a return. You're also going to get appreciation on the property, right? Typically 3% a year. The stock market has appreciation, but one of the things that the stock market doesn't have is leverage. And so if I take, let's say $50,000 and I put it in the stock market and it earns 5% a year, now I'm left with, drum roll, $52,500. Versus if I took $50,000 and I bought a $200,000 property and it gets 5% a year, my appreciation is $10,000, not $2,500, right? So that leverage. And then the fourth benefit, which is hopefully what we'll get into today, is tax benefits. The tax benefits are a lot better investing in a real estate than they are the stock market. And then the fifth almost, it should be a fifth pillar, but you don't ever see a building that has 5 pillars. It's normally just 4, but it's an inflation hedge. And so if I'm able to borrow money 2 years ago at 3%, 4% interest rates, but I'm paying that money back over 30 years over time, there's an inflation hedge, because if I'm borrowing money at 3%, but I'm paying it back when the dollar is worth less, let's say interest rates are 8, there's an arbitrage there of I borrow money at 3%, but I'm paying it back in high interest rate environments. So I'm essentially paying back less money. And those sort of pillars, really tax benefits is what I got into, but those are the pillars that makes real estate a lot more favorable than the stock market when it comes to overall investing.
Yeah, absolutely. One thing I'd want to point out is, so you said leverage, which for anyone listening could also be interpreted as risk, right? More leverage. Sure. Could be riskier, which would result in better returns, right? Which is one of the reasons why long-term real estate can be very, very, very lucrative for an investor if they're doing it the right way, is because you are able to use leverage, which means, yes, you have more risk, but if that works out in your favor, there's more reward. And so I wanted to kind of just point that out because that jumped out at me. I saw somewhere you mentioned you do also have stocks as well, right? Like you have a combination of both.
Yeah, I would touch on that too. So I actually did a podcast a long time ago, probably over a year ago, talking about, and I forget exactly what the title of it is, but it talked about leverage in real estate. So if you have $100,000 cash and you're looking at either buying one $100,000 property, or you're going to lever up and let's say buy 4 $25,000 properties, every single time the math is going to make sense that you're going to make more money by taking out leverage. But that's in a perfect world, right? And there's some, based on the economic cycles, the upturn, the downturn, the trough, and then, the eventual upturn again, depending on when you do that, you might cycle out. You might get in at a really bad time. Like let's say people that bought properties a year ago with 6-7% interest rates, can't find anybody that wants to rent them or whatever. So you could get in at a bad time, but the idea is long-term, 30 years, very similar to dollar cost averaging in the stock market. As long as you get in and the deal makes sense, you should be able to wave through that economic downturn. But the idea of the podcast was, in a perfect world, you're going to make more money using leverage, but leverage doesn't account for that personal risk tolerance. And depending on who I'm working with, I'm looking at their overall net worth and then making a decision on what they're going to invest in. Because if somebody has a really strong net worth, then they can take on more leverage and more risk. If somebody has a lower net worth or lower income, they don't have the potential to take on more risk, right? And that's kind of the balancing act that I do across everybody's portfolio. I do stocks, and my personal take on this, for me, if you're an entrepreneur or you're a business owner, you're investing in real estate, what I do personally is I figured out through time value of money calculators, hey, if I want to have let's say $5 million when I go to retire, and I could blow every single real estate deal or every single business that I ever do, but if I want to have $5 million when I retire, here's how much I need to invest per month. Maybe that's, let's call it $800 a month. Anything on top of that, let's say I have a $1,500 of surplus income, I'm going to put $800 in the stock market, and the other $700 is going to go towards real estate or funding those other businesses. So that's my philosophy. If you're an entrepreneur, is figure out how much you need to have in retirement, invest that into stocks, but then any surplus income should be going towards growing your business or real estate portfolio.
Dude, that's really interesting. So a lot to unpack there, but I would not have expected that answer because, just being the real estate guy, I would have expected I've got a small little portion over here, because of X, Y, and Z, but no legitimate purpose. Whereas what I heard was you're relying on the stock market almost as I don't want to say stable. That's not the right word, but that's kind of the nest egg you're building, and you kind of know it's going to be there. It's not guaranteed, but there's a very good probability that money's going to be there if you put the money in based on your calculation when you go to retire. And then the real estate's just your ultra growth portfolio, anything above and beyond that. The real estate's probably what's going to make you the ultra wealthy person 20, 30, 40 years from now. But if it doesn't, if everything goes wrong, you're counting on the stocks to kind of be your quote unquote risk-free part of your portfolio. So that's really interesting. That's what I heard. I don't know if that's how you were saying it, to be honest.
It's exactly right. It's exactly how I meant it to be too. So
I think
I'm Coast Fire right now, which means I don't need to invest another
Don't say the word fire
10
on
into the
here.
stock market.
It's not allowed. Not allowed.
10-4.
I'm just kidding. There's so many different. I didn't even know there was more than one fire until a couple of years ago. My buddy he's another advisor, and he's like threw out like 9 different fires, and I was like, dude, like at some point it's not fire then, right? Like, I mean, what are we doing here? I don't really relate with I guess the traditional fire method, but I don't know all the additional ones. So tell us, what is coast fire? What does that mean?
So coast fire to me means I don't, as far as hey, I need a net worth of X when I retire. Coast fire means you don't have to invest another dime to meet that goal. Basically, your investment portfolio now compounded over time will get you to that goal when you go to retire. So,
and do you have like so here's my problem with fire is traditionally what I've always seen. It's like, I really hate my job. So what I'm going to do is I'm going to live ultra frugal, like on like pennies for 10 years, sacrifice as much as possible at this high paying tech job that I have, take that money. And then I'm going to be 35 and then I'm going to live off of like, 20 grand a year. And I'm like, that actually kind of sounds awful to me. Because one, you don't actually know if life's guaranteed for 10 years, right? So you can sacrifice for 10 years and you could be diagnosed with cancer the next day. I lost my mom at a young age. So personally, like that's part of my background is like, I can't do the whole just sacrifice and live off the land for 20 years. So that way I can, have $20,000 a year and retire at 35. But what you're saying is different. It's like, no, I'm just kind of on a sprint to get X amount and then I can do whatever I want. So it's not even necessarily like retire based on my understanding, right?
Yeah, and I don't even know because I've had that conversation before trying to project out what my businesses would be worth at 30, 35, 40, and just saying, okay, I could sell for X and then right off into the sunset and not have to work anymore. But I'm really trying to, at least over these next 4 or 5 months, position myself so that the only thing that I'm doing on a day-to-day basis is doing the things that I truly love to do, what's called my genius zone. And the genius zone, there's a book written where it talks about most people only spend 10% of their total time in their genius zone. And so the genius zone to me is either two things. It's your highest and best use of your time from an economic standpoint. So highest, dollar amount. If I'm doing tax strategy, that might be $500 an hour work or $1,000 an hour work, or it's spending time with my family, right? That's my genius zone. And the book kind of talks about you need to learn how to delegate and automate those tasks that don't fall into that, such as, for me, it's like cutting the grass or a lot of the admin tasks in my business. I have admin or other people do. And where was I going with this? But that genius zone is that highest ROI part of your time. And if I can position my business and my life to only do that, I don't think I would even retire if I wanted to or could.
Yeah, because you're kind of living the life you want. That's what I align with. I'm with you on that. So we'll just make up a name for that. We'll call it an intentional business rather than fire. How's that sound?
Yeah, the way that my mentor calls it is basically architecting your income. So you're the one that's in charge of saying, okay, I'm going to make X amount of dollars this year, but how am I going to make it? Is it one-on-one, very intensive client work, or is it shifting a lot of your income to more of a group coaching? The group coaching program that I have now represents a lot of my monthly income, and it requires 1 hour of my time per week is that one group coaching call. Sweet.
I like that. So financial advisors, we're a little more highly regulated. And so there's like very few of us talking about how do we figure out how to do this. And there are options, right? And it just kind of involves not giving specific investment advice because it's really hard to do that on a group scale. So I like what you're doing there. Financial advising is probably about 15 years behind every other industry when it comes to like marketing and new types of things. And that community group model is definitely, I would say the last 5 years has really started to pop up. You mentioned something earlier. I want to get back on track with real estate because I could talk about the intentional business stuff for a whole hour. You mentioned when you have someone you're working with, you're looking at their net worth to figure out like what makes sense for them. And I'm curious because I hear from a lot of people who want to get into real estate. When I look and I'm like, you have no business doing this. And so I'm curious, what's that like bare minimum? Like, or I guess, what are some things that are immediate, like red flags, you're not ready for this? Or do you have like a standard of they need to hit like X, Y, and Z before you'd even consider like recommending them into any type of real estate?
Yeah, anybody that wants to go head first really super fast, that's a red flag and that's a warning sign. So one of the things before even somebody does a deal is, hey, are you maxing out your Roth IRA every single year? Are you at least taking advantage of your employer match of your 401k? Are you kind of checking those boxes off? As far as it comes to deal specific, I'm always recommending, and that's kind of goes into the teachings that I do based on pro formas of, is the property actually going to meet a gross revenue target? Do you have reserves in case that you need to weather some storms? So typically, most of the time, you're going to want to have 5 to 6 months of expenses for that property ready to go in the event that you can't find a tenant or you can't rent it out to anybody. It's checking those boxes. And the thing is the math will work in all 50 states, right? So even though a lot of people from California like to invest in Ohio or different states because it's a lot cheaper, but really the math works in all states. And it's kind of checking those boxes off to know if somebody's ready or not to invest. As far as that net worth goes, the higher the net worth, the more they're able to, so to speak, take on risk because they have the ability to stomach it. So I talked to somebody the other day, maybe $2 million net worth through 401k, primary home, and cash. And they said, hey, I'm trying to figure out if I should buy a $400,000 property for my first deal. But my fear is I'm going to be buying, would I rather buy two $400,000 properties, spend twice the amount of time, or buy one $800,000 property? It might be a lot more risk because it's one property. And I said, well, your net worth and your income, you can afford to take that risk versus somebody who has half the net worth or not even that same similar level, not enough income. They can't stomach that risk if they were to have a 10 or 15% loss. So the better your overall financial picture, the more aggressive you can be on your investing side. And that's what I try to recommend people to do.
I actually had this question written down, so it's going to parlay really well into that. Do you need more than one property to do well in real estate? Do you need to scale? I've kind of heard that before, and I didn't know if it was a myth or not, that if you're only going to have a couple doors, I guess is kind of what it's called in the real estate community, which is kind of, for apartment complexes and multifamily homes, if they have multiple units, they're called doors, I guess. But what are your thoughts on that? Can you be a small-time real estate investor, a couple properties, or do you need to scale it?
Yeah, when I first started off and reading kind of the Bigger Pockets books, it was you're going to make $250 a door and you just need 100 doors to be financially free. And then that's when I got into that thinking bigger, and especially short-term rentals, where instead of making $250 a month, you can make $2,000 a month on the same property or one property. Me personally, I'm trying to get to my financial goal. So for me, it's more of how much cash flow do I need for my rental portfolio per year rather than hey, I'm going to get 5 properties, 6 properties, whatever it is. Whenever somebody tells me I'm going to buy 5 properties or 6 properties, I always spin it back to say, is it really a property goal or is it actually a cash flow goal? Do you need to have 5 properties before you quit your W-2, or do you need $15,000 of income coming in per month in order to quit your W-2? For me, I would rather have one property, 100 unit apartment building that represents all my rental income than deal with 5 to 10 properties. Eventually, my portfolio is going to be condensed into one super mega building that I have one point of contact, which is probably going to be a property manager.
That makes sense. You do a lot of short-term rentals. Is that what you said?
I do short-term rentals, single-family homes, glamping, and RV parks. But I would say when somebody's first getting started, they obviously have to start a lot smaller, and that's where you'll go and buy a cheaper house, learn a lot, and then go to buy more and just kind of scale and domino effect from there. It also kind of goes into what I call the return on hassle, ROH, because if you're that person that's like, hey, should I buy 2 $400,000 properties or one $800,000 property? Well, if you're a doctor or a lawyer, you're already working a lot at your job. You don't have time to buy 2 properties, So that also becomes a perspective of, hey, there might be a lot more risk buying one property because, hey, it's one roof, one insurance versus 2, and maybe the 2 properties are spread out, so you're limiting your economic risk. I met a guy one time, he had 5 properties in the Smoky Mountains, all in the same cul-de-sac. They all burned down with one fire, took his whole portfolio out. Insurance paid him out, but it did set his retirement goals back a little bit. Sure. Versus maybe you have those 5 properties you got one in Tennessee, one in Florida, one in Alabama, one in North Carolina, like spreading out your risk. But then you lose out on that economies of scale, right? He had all 5 properties in the same area, same cleaner, same handyman, easier to work with. And that's also what we've helped people do too, is either divest or reinvest. So we've helped people go from 500K properties to $1.5 million property. And I've also helped people go from that $2 million property that just isn't working out to a similar size portfolio, but 3 or 4 properties.
What are you usually looking at? Is it like just like a regional thing where it might make more sense to have multiple smaller less expensive properties compared? Like, so what you're saying is like sometimes it makes more sense to just get one property that's worth the same amount as the 3 properties, but then it sounds like sometimes it also makes sense to do the reverse. Like, what are you looking at in those situations?
It depends on the risk tolerance of the person.
Gotcha.
And it also depends on their overall, net worth. If they have a more sound net worth, I think they're better off making that 1 property instead of 3. But if their net worth isn't as much, hey, it's baby steps. Let's buy the first one, buy the second one, get the third one going. But when you're working with individuals that are making, $100 an hour plus at their day jobs, that return on hassle becomes very important as how many deals they're able to actually do per year.
Yeah, so I got a couple thoughts here. You keep saying return on hassle, so I got to ask you, is real estate passive income?
No.
No, it's a business. Like, I think that's one of the biggest misconceptions I hear, because I work with a lot of online business owners. They start to free up cash. They're doing well, and they start talking about real estate. And I'm like, you could do that. Like, there's great opportunities out there for that. But do you have the time to do that? Because that's another business. But they hear passive income, and they think, oh, I just going to put my money in a building, and, it's just going to produce cash flow. And so I always have to ask, like, do you consider it passive income? So I think we're in agreement there. The other thing I want to talk about, you keep saying risk tolerance. If you're someone who's not in real estate now, but you're considering it, you're thinking about it, which is probably most of the people who are listening to this, how do you know what your risk tolerance is for real estate? Because I'm even listening to this and I'm going, you're never really going to know until you buy that one property.
Mm-hmm.
There's only so many surveys, questionnaires you can take, but like for me in the stock market, right? I find out what someone's true risk tolerance is when stocks are plummeting, like COVID, and they're calling me or they're not calling me, right? So it doesn't matter what their questionnaire said. That's only so helpful. I find out what their true risk tolerance is the moment that stocks shit hits the fan, and they're either calling me like, we should sell everything, and I'm like, pump the brakes, or I never hear from them. So I'm just curious for you, because obviously like the liquid, like it's different. You can't just like up and sell the property. I mean, that's a process.
So the risk tolerance to me is numbers. It's okay. You're a millionaire net worth, but how much of that is in rental real estate equity versus equity in your primary home or the stock market or other accounts? If you have $1 million net worth, but you got $200,000 of equity in rental properties, that's not too bad. If you flip that and you have $1 million net worth and 800,000 of that's tied up in rental properties, you have a cash flow problem. You probably have a cash problem because that money is not liquid as much as it is on the flip side, where you have $1 million net worth and 800,000 of it is in basically your personal name. So that's another thing about real estate too, is because it's an imperfect market. So if you and I both pull up Apple's ticker right now, we're going to buy it at the same price. Versus like you and I could go look at the same property. I might have a better property manager. I might have a better real estate agent. I might be able to negotiate. I might be better at negotiating than you. And so that's where it's imperfect, where the stock market is like an efficient market and real estate's inefficient, to where similar buyers can come to the table and get two totally different deals. That's where the competitive advantage in real estate comes in compared to the stock market. But also a big reason why real estate is illiquid is it's really hard to value real estate. There's Zillow, there's Redfin, you can get appraisals, but it's not similar to the stock market, where every single day you're seeing the Dow Jones or the NASDAQ go up or down, and it causes fear and it causes panic. If you could legitimately pull up every single day, see the value of your house, it would cause like financial turmoil, because people would just, if they saw that their house dropped 15% in value one month, they would just sell very similar to the
That's
stock
one of the
market,
biggest benefits. That's one of the biggest benefits
yeah,
of real estate that financial advisors sometimes talk about is that you can't sell it, right? So with the stock market, obviously, like you can panic and you can sell, but a lot of the middle class is built off of the equity in their primary home, which
yes,
statistically, if you run the numbers, I think you said earlier, like 3% appreciation over time. Statistically, if you run the number with, adding in all the costs, et cetera, like you may come out ahead, but it's not a whole lot, and it might not even beat inflation over a long-term period for a primary home. I'm not talking investor real estate. But the benefit is that you can't do anything dumb with it, right? You can't just like all of a sudden sell it because you're scared the market's going to go down. You just continue to live in it. And that is one of the biggest benefits because there's a line I've heard about stocks that I really like. It's kind of like soap. The more you touch them, like the more you touch them, the less there is, right? And so when people are in there trying to sell stocks and stuff like that, like it's going to hurt your account, right? Like most likely you're going to lose money doing that. And so that's one of the biggest benefits, I think, of real estate as a primary home. So you just kind of mentioned that, made me think of that.
The Fidelity did a study on 2020 or 2000 to 2020. Do you know the number one type of account that returned the most investment in 20 years? Do you know what they all had in common?
I'm gonna assume real estate.
No. Okay, Fidelity looked at their overall stocks, and they analyzed that there was one trait that all these people shared that had the highest returning accounts. Do you know what the trait was that they had?
They made less trades.
They were dead.
Oh, I did see that. I know what you're talking about. Yeah,
dead people.
Which actually equals less trades. Yeah. Yes. Yeah. No, they were dead people because they couldn't trade their money.
And then guess what number 2 was?
I'm not sure. You have to remind me. I did see
people who lost the password to their account.
Yeah, so it all goes back to the soap analogy. The less you touch it, the better off it is. So we're going off on a tangent here, but you made that point about real estate. I wanted to point out that's actually a really big benefit. And that's how a lot of people build wealth in the middle class. Traditionally, our middle class is kind of changing in America now, but
and be able to pass it down. Because
exactly.
real estate is essentially primary ownership. It's a forced savings account. And that's normally the only asset that like poor middle class families own is a primary residence. Mm-hmm. And they don't really know it, but like they are building up equity in that. And that's how, because everything else they buy, like cars, watches, whatever, it goes down in value. And that's, right. I'm a big proponent of that. And that kind of leads into some of those tax plays, because if you inherit a property from a parent, you're going to inherit it tax-free with a step-up in basis. And that's a way that real estate gets passed down. Yeah. So
explain that. I know what that means, but listeners might not.
Yeah. So let's say I bought a house, grandma buys a house when the dinosaurs roamed the earth back in 1950 for $50,000 in Chicago. And now that place is worth $500,000. So if grandma was to sell it before she passes away, she's going to pay a capital gain tax bill on the difference of, $550,000, let's say. But if she passes away with the property in her name, it goes to her beneficiaries with a step up in basis. So I inherit the property at $500K, not $50. So if I was to inherit it and sell it the next day, I'd walk away with no tax. And that's one of the ways that wealth is able to transfer from poor middle class families is through that step up in basis. But then also with primary residence ownership, if you own a property for 2 years at least, you normally can sell it completely tax free. If you're single, you get up to $250,000 of gain. If you're married, you get $500,000.
Yeah, no, that's a big rule that most people don't know. They're always like, "Oh, I'm going to owe so much in taxes," and it's kind of easy to fit into that rule. I mean, I think it's like 2 out of the last 5 years you have to live there primarily. I think there's one other test that I'm forgetting, but if it's your actual home, you're probably going to qualify for it. Tax benefits. Let's get away from primary home and talk about the real estate investing. What are some of the biggest tax benefits that lure people in, and why? Like maybe why should a business owner be considering it? Like what are some of the tax benefits that would that they should consider investing in real estate for?
Yeah, I mean, if you let's say you brought in $250,000. If it's in your business, there's only so much things that you can do to lower that, right? You can spend a bunch of money on supplies or goods that you don't necessarily need to try to lower your income. But in real estate, like, you can take that money, put it into properties, and a lot of the expenses that you have associated with the properties, like mortgage insurance, taxes, interest, HOA fees, are deductions towards your income. But most importantly is this thing called depreciation, that if you own property, you get depreciation. And that's where you have cash flow positive, but you actually show the IRS that you have a loss. So you might have a property that, let's say, it's making 10 grand a year cash flow, but your depreciation on the property is $12,000. So even though you made $10,000 in cash, you get to turn around and tell the IRS that you actually lost $2,000. So you don't pay any tax on the 10 grand in cash flow. And then what we strategize with clients is, they are business owners, they're high W-2 earners. How do they actually take the losses from the real estate and use it to offset their high income?
Explain depreciation to me like I'm 5 years old.
So when you buy a property, the components of the property lose value over time. So the furniture, the millwork, all the contents inside of the property actually lose value. And it makes sense, right? The roof deteriorates over time, the siding, everything loses value over time. And depreciation is the IRS's way of assigning the value of the property contents losing value over time. We know that real estate tends to go up in value, like appreciate, but you actually get depreciation to help offset your tax bill.
Okay. So since you kind of just broke it out there, there's also cost segregation when it comes to depreciation. So why don't you break that down as well?
So normal depreciation is based on the type of property class. So for short-term rentals, it's 39 years. So if I bought a $390,000 property, I'm going to depreciate over 39 years. So I'm going to get $10,000 of depreciation per year for 39 years. A lot of people don't even own properties for that long, right? But I'm going to get $10,000 a year to go against my cash flow. So let's say I made $30,000 on the property. $10,000 is going to go towards offsetting that 30. So now I only pay taxes on 20. What cost segregation does is it essentially accelerates the depreciation. So instead of only taking $10,000 in the first year, generally you're going to get about 25% of the purchase price in the first year. And so I'm going to get $80,000 of depreciation instead of $10,000 up front. And now instead of having $30,000 of income, I'm actually showing a $50,000 loss because I had $80,000 of depreciation to go against $30,000 of income.
And would that offset your business income?
If you meet certain requirements, it does. And that's what I help people navigate through. You generally have to, if it's a short-term rental, you have to meet a 7-day or less on average stay for your guests. And you also have to basically self-manage the property yourself. You can't have like a property manager do it. But we have clients that are business owners. They might be doing e-commerce, lawyers, doctors that make a really good business owner salary and invest in short-term rentals and use the losses to offset their income.
Gotcha. That sounds like it would be extremely beneficial to a business owner. What happens, because you kind of mentioned this, so a lot of people don't actually own the property for, say, 39 years. What happens when you sell that property? Like, how does that depreciation come back into play?
So when you sell the property, that's normally when it triggers what's called depreciation recapture. So you do have to pay that, basically the tax benefits that you got, you do have to pay them back unless you do other strategies like 1031 exchange, or I call it the poor man's 1031. It's where you sell and you buy a property in the same year. You can use the losses from the new property to help offset the gain on the old property sale. But the idea of that is time value of money. If let's say I'm in a 30% tax bracket in year one when I buy the property, so I take $100,000 of depreciation, multiply by 30%, which is my tax rate, I save $30,000 in year one. And then in year 5, even if my tax bracket's the same in year 5, I still got to basically borrow that $30,000 tax, penalty, and interest free for 5 years. Even if I was to pay it back in year 5, I still got to take advantage of that. And then hopefully you're in a lower tax bracket when you go to sell a property. So I might have been in a 30% tax bracket in year 1, but when I go to sell a property, maybe I'm only in a 22% tax bracket. So I'm also gaining there too, because the money that I'm paying back, it's actually less money that I'm paying back, and I had to pay it back 5 years later. You're never going to find anywhere you get an interest-free loan.
Yeah, no, I think that's a really good point. I've never actually heard it presented that way. But I wanted to bring up the depreciation recapture because I feel like a lot of, like the TikTokers and et cetera, they kind of leave that little context out of there. And for someone who's building like a mixed portfolio of stocks and real estate, it might not be that big of a deal because maybe you're not going to be forced to sell or anything like that. But with real estate being illiquid, if someone's all in on real estate and they do need money and they have to sell off a property, then I think it's important for them to understand what depreciation recapture is. And it just kind of gets left out of all those, trendy TikTok videos. So I appreciate you kind of diving into what that is and how it comes into play. As we start to wrap this up, anyone who's listening who is interested in they think real estate's for them, they've been listening, this all sounds great to them. What are actionable things they should go back and look at to really determine okay, you have the capacity to really consider taking on real estate as a risk in your portfolio?
I would say at least a 6-month emergency fund of household expenses, good down payment on a property or on an investment property, and then most importantly, a life plan or a 5-year goal plan. A lot of people.
What's a good down payment though? What percentage wise, right? Because I know 20, a lot of people 20%. Think 20. Okay, all right.
Realistically, you're going to need 20%, and then you're also going to need 5 to 6 months of reserves for the property as well. You can get secondary home loans on vacation rentals for as little as 10% down. I've never done it, but there are those loans that exist. So you can put as little as 10% down. For me, I envision that all the properties that I own, I probably won't own 5 to 10 years from now. And when you look at the interest amortization, when you only put 10% down, at that 5-6 year mark, you're not even really paying down that much principal. So I try to put down more money on property so that way I at least have some equity or I have some loan pay down. That's me personally, but everybody's strategy is a little bit different. There's a lot of guys that want to have the least amount of money out of pocket as possible, and that's fine. I would rather at least, even if I'm holding onto a property for 10 years or less, I want to have at least some equity pay down.
No, that's fair. And then I apologize to cut you off. You were going to say something about a life plan or a 5-year plan.
Yeah, it really just is. It's not about what are you going to do for that next deal, but what I really try to teach people is how are you going to acquire the second and the third property? Because let's say you have a primary residence and you make $100,000 salary and you already have a primary residence, so that adds to what's called your debt to income ratio, and you go and use 10% down on a secondary home, and you max out what's called your DTI or your debt to income. It's how are you going to get another property? Because you either have to pay down your primary or the other property, or you have to just make more money. Versus actually analyzing, okay, I could buy a property this year, I could buy a property the following year, and kind of working back to how you're going to be able to do that. I think the hockey quote is don't skate to where the puck's at, skate to where it's going to be. And I don't think a lot of people are thinking 3-5 years ahead. They're just focused on getting that one deal, which I don't think is a bad thing. Paralysis analysis has definitely stopped a lot of people that I know from making a lot of money because they sat on the sidelines in 2021, 2022. But there's also the quote of, hey, if I had 12 hours to cut down a tree, I'd spend the first 10 sharpening the axe. I think you really need to know when is it time to sharpen the axe and when is it time to actually just start cutting down the tree because we're about to run out of daylight, right? So knowing when is it time to sharpen your axe, build up those skills, and then also knowing when is it time to take action is also important.
Cool, man. Well, I appreciate you sharing that, and I appreciate you coming on and talking about it. Really fun conversation. I think it's a good introduction to real estate. We kind of threw a lot at people, but if they listen to this and they want to learn more, they should definitely be following you. So where can they go to learn more?
Yeah, it's going to be all social media platforms at Learn Like a CPA. I respond to all my DMs too, so it's not like a bot or somebody responding. It's going to be me responding.
I can confirm he did respond.
Yes. And it'll be, if you're on Facebook, it's called Tax Strategies for Real Estate Investors. We have over 6,900 real estate investors in that Facebook group engaging daily. So those are the best places to find me.
Man, well, I appreciate you coming on, and hopefully people will go check it out and learn more about real estate. I really like your approach. And I love the balance that you're coming to this, to the real estate game with, and not just kind of all in on one thing. So appreciate it. We'll catch you later.